Hopes are high for the US to cut interest rates. Investors are awaiting tariff certainty, and Nvidia becomes the equal biggest company in the world, and Meta moves into defence. While down under, the Aussie share market could be due for a haircut. After all, everyone needs a trim every then and now. My name is Jessica Amir, market strategist with Moomoo. It's great to have your company on this 30th day of May. So we're seeing US stocks rally but fail to hold gains, and it's for several key reasons. And I basically think that this sets a cautious tone for equities and commodities today down under. But let's just pause and have a look at the S&P 500. It's now up 19.3% from that April low, but it could be due for a little bit of a trim here. And those reasons are threefold. Firstly, we had US GDP data overnight showing that consumers, they're spending less. Corporate profits are down too, and this basically reflects that companies are swallowing tariffs like a bit of a jagged pill. Secondly, equities could be due for a haircut because we do have that court appeal being blocked. Basically, that tariffs trumps won't be removed. While thirdly, we do have geopolitical concerns rumbling, and that's because China's are now calling Trump's administration discriminatory after removing Chinese student visas. So this is why we're now seeing bets rise for the Fed to cut interest rates twice this year. So this is basically setting, I guess, a tone that we're seeing investors favour quality stocks, as well as sectors that stand to benefit from interest rate cuts. And this is precisely why we saw the real estate sector lead the gains in terms of the sectors. It led most sectors higher, only one sector closed in the red. Should the Federal Reserve cut interest rates, it would definitely be supportive of stocks, wouldn't it? And also gold for that matter. Both to potentially continue to rise over the longer term. And that supports the market rallying into the second half of the year. So that's something for you to consider. The bull scenario does remain intact. But the thinking is company earnings are so strong that the market could keep on rallying regardless of what the Fed does. So that's another catalyst for you to consider. Now, Nvidia overnight became the equal biggest company in the world. It's neck on neck with Microsoft. After it rose 3.3%, it's just shy of $140. Rather, it's at $139.20, and that took its market cap to 3.4 trillion US dollars. And most Aussies are indeed holding Nvidia because super funds down under are holding S&P 500 and NASDAQ 100 stocks, and Nvidia is now the biggest company equally in the world. Let's speak about defence. So Meta overnight basically moved into defence. They partnered with a company called Anduril Industries. They're basically going to develop products for the US military, including an artificial intelligence powered helmet with virtual and augmented reality features. That's pretty exciting. So we know that they're not only doing Ray-Ban glasses, but they're now going into hard hat helmets with virtual reality. So basically, what you need to take away from this is two things. This should serve as a reminder to investors to consider having some exposure to defence stocks. You've got to remember that NATO, that body, is advocating that economies across the world spend 2% of the money that they make on defence. Combined, you're looking at $485 billion. And the US is pushing its defence spend, remember, to $1 trillion. That's something for you to consider. Also, by the by, for those technical traders out there, it looks like Meta shares formed a double top. They could be due for a potential pullback before running up again. So just keep your eye on that. Moving to this defence ETF, we've just flashed on the screen. For those tuning in on our podcast, we're showing the DFND ETF. That's VanEck's Global Defence ETF. It's done extraordinary things, hasn't it? It's punched the lights out. It's up 47% this year. So well done to you if you've got exposure to that. But this has definitely got some tailwinds to keep on gaining gusto and heading higher. Down under, what about the Aussie share market? Well, we spoke about everyone needing a trim every now and then. I know I need a trim, but a bit of a cautious tale for the Aussie share market. We've spoken about the Aussie share market being putting on some pretty cracking performance of late. It's up almost 15%. I'm being generous rounding there. But the market is basically looking a bit toppy. It could be due for a pullback. It's in technical overbought territory. And I think that yesterday's inflation data locally, for those that missed that, we saw CPI blow a little bit hotter than expected. And that's not really what the market needs while we do have these set of conditions locally, but also globally as well. Now, today we've got private sector credit and retail data. Basically, if we see the Aussies aren't spending how much they're expected to at the shops, that could send markets into a tiz. But remember, markets don't go up in a straight line. So if you've got some profits, maybe you could potentially consider them. Consider taking them off the table and keeping your powder dry for a day when you can buy stocks you like at a cheaper price. For information on the stocks and ETFs we've mentioned, head over to Moomoo's platform. Have a great day. Happy trading.